China's financial system is on the brink, which will force the PBOC to do this. I'm your host, Steven Van Metre, and thanks for joining me today. And with credit conditions in China rapidly collapsing, the People's Bank of China is eagerly trying to shore up what could be the beginning of another housing-led great financial crisis. Let's pick this story up where borrowing by Chinese businesses plunged in the first quarter and interest rates on loans surged to record despite the central bank's effort to encourage more lending, according to the China Beige Book. Only 16% of companies surveyed by the CBBI, a provider of independent economic data, applied for loans in the first 3 months of 2022, the lowest since the quarterly poll began in 2012. And this is important to understand because in a fiat money system, how is new money created? You got it, when people borrow. And so without borrowing, you have a lack of credit creation, a lack of money creation, and that leads to financial crises. The firms also paid the most costly loans since 2012, even though the People's Bank of China cut its policy rates early in the year. The average interest rate for bank loans climbed to 8.5% from 6.1% in the fourth quarter, while those for shadow financing loans surged to 15% from 10.7%, according to the data. And here you can see in this chart by Bloomberg that Chinese companies' loan applications plunged to the lowest since 2012 at the same time where you see these same companies reporting the highest loan interest rates since 2012. And this is something I've been talking about, and people do not understand that when interest rates go up, demand for loans goes down. And so you have what's the credit creation engine, which is spurred by low interest rates, just dries up completely. And this is how we have recessions in fiat-based systems, is you see central bankers or policymakers will ease financial conditions by lowering rates, and then when inflation gets out of control, like it is now, they start tightening policy by raising rates, and it kills credit. But yet here in the United States, so many people talk about how interest rates can only go up, and yet every time they go up, they make new all-time lows. And why is that? One simple reason why is because demand for loans goes down, and here you can see in China the same thing is happening. But yet there still is demand for credit as measured by the share of companies who wish to borrow but nevertheless didn't apply for loans rose in the first quarter in all the surveyed sectors. So what happens is people still want to borrow, businesses still want to borrow, but they don't want to borrow at high rates. And so what they're willing to do is sit on the sidelines and wait, and either until there's a recession, central bank intervention, or just a lack of lending demand sends rates lower. And that reflects the high borrowing costs that implies a company's appetite for credit may turn around quickly should the PBOC aggressively cut rates. And here in the U.S., the same thing would happen if the Fed were to cut rates, but we know that that's not going to happen. The People's Bank of China is leading the effort seeking to shore up confidence in the $60 trillion financial system as the economy slows and a debt crisis in the property industry spreads. The Stability Fund would dwarf other pools available to bail out troubled institutions and their depositors. And if you're concerned at all what a blowout in the China real estate market could mean to your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up there in the corner and the description below. You'll be glad you did. Let's continue on with the story, because China is moving to stem financial risk ranging from hundreds of weak rural banks and to dozens of distressed developers saddled with at least $1 trillion in liabilities. Challenges are mounting as the debt crisis ripples through the property market and as a resurgence in COVID infections forces a partial shutdown in Shanghai, threatening to sap momentum in the world's second largest economy. While the key mandate of the new fund is to rescue financial institutions, it could indirectly help too big to fail entities in other sectors, including real estate, by providing financing through banks. And this is no different than back when the Fed was buying corporate bonds, and notably, they were buying bonds from companies like Apple, who absolutely needed no financial support from the Fed, and yet there the Fed was buying Apple bonds, and it didn't make any sense as companies, perhaps that needed the Fed to buy their debt, well, they didn't qualify under the Fed's rules, and of course, we know that many of them struggled, some of them failed. Similar story happening here in China, taking a page right out of the Fed's book. And this would be the first fund dedicated to ensure broad financial stability, unlike previous funds that were more targeted. The PBOC labeled 316 financial institutions as high-risk entities in the fourth quarter, most of them small rural banks. Confidence in the regional banks was jolted in 2019 when regulators seized control of Baosheng Bank in Inner Mongolia, the first such move in 2 decades, and imposed losses on some creditors. Authorities have since orchestrated bailouts have two other banks intervened to quell at least two bank runs. And setting up a stability fund signals regulators are taking a proactive step to prevent the potential spillover effect from developer default to the financial system, which can mitigate the credit risk facing banks in the long term. More importantly, China does not want to be the one who sends the world into a recession. We remember that the last housing-led global financial crisis started here in the United States. And this would not look good for China, particularly right now, if their whole financial system cratered under their Ponzi scheme real estate system, and that caused another great financial crisis. The world will not look upon them the same. And the situation there is pretty ugly, because you can see this recent risk test by the PBOC that 7% of Chinese banks were rated poorly in their test. Now, could you imagine for a moment that here in the U.S., if 7% of our banks were rated poorly, what kind of confidence people would have in our banking system and financial system? They would have none. They would be constantly worried about who's going to fail. But in China, this appears to be business as usual. And this will have a knock-on effect as home sales across China's largest city remain weak in March, however, tumbling 45%. And this was the experts warn the housing market may have peaked in 2021 as population and the pace of urbanization slow. And what's one of the most important things when it comes to credit creation? It's the real estate market. It's true here in the U.S. It's really important in China as well. And without people buying homes and borrowing money, well, what you have happen is, again, money growth slows because we know that in a fiat system, you need to borrow money to spur credit growth. And if people stop borrowing, credit starts to contract and you get a financial crisis. This happens every time when central bankers subsidize and crush interest rates down, inflation gets out of control, and then they have to come back and tighten. It reduces credit growth to the point where the economy just collapses. And regulators have recently eased a year-long cap on home sales and called upon its largest bad debt managers to join the restructuring of weak developers and their lenders after firms including China Evergrande Group defaulted on more than $7 billion in offshore bonds and consumer stage protests over unbuilt homes and soured investments. And so now it starts to make sense exactly what the PBOC is doing. They're afraid of another financial crisis. They're afraid the real estate market's going to collapse, and they're afraid they're going to take the world down with it. So their only solution now is to set up a bailout fund and hope it works. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.